Your net worth can be wrong even when every account is accurate. The problem is fragmentation. Cash at one bank, retirement at another, a brokerage, property, vehicles, and debt in separate places. A net worth tracker should turn those disconnected records into one personal balance sheet you can actually manage. Use the 3-layer balance map: inventory, classify, then verify. Step 1 is inventory. Open the balance page and build the list before you judge the result. For every item, capture the type, category, valuation method, amount, currency, custodian, account, project, and item name. Start with checking and savings, because liquid cash affects both resilience and the decisions you can make next. Then add retirement, taxable investments, bonds, property, vehicles, and any other asset with a defensible current value. Add liabilities separately. A mortgage, auto loan, credit balance, or personal loan is not an expense category. It is a claim against your assets. Step 2 is classify. The same dollar can create very different risks, depending on what it is and where it sits. Use the nature view to separate cash equivalents, financial assets, property, vehicles, and other alternatives. Use the currency view to expose foreign exchange concentration, instead of assuming every holding behaves like your home currency. Use the custodian view to see whether too much wealth depends on one bank, broker, or self-held asset. Use the project view to connect money to purpose: core living, emergency reserves, retirement, education, a home, or long-term investing. Your financial plan becomes useful when it reflects non-financial states too: where you want to live, how much flexibility you need, and what work you want the option to leave. Step 3 is verify. Net worth equals assets minus liabilities, but the total is only the first check. Separate valuation growth from contributions. A rising balance can come from saving more, market appreciation, debt reduction, or all three. If one large account is missing, every percentage underneath can look precise while still giving you the wrong allocation. Update the map monthly and immediately after a major event such as a raise, a home purchase, a new vehicle, refinancing, or taking on new debt. For example, a new car may add a vehicle asset, an auto loan liability, a payment, insurance, and depreciation at the same time. A salary increase improves cash flow, but it does not increase net worth until the surplus is saved, invested, or used to reduce debt. The operating routine is simple: reconcile the rows, inspect the 4 mixes, verify net worth, and write down the next decision. In the next episode, we will turn that balance sheet into a cash flow plan and calculate how much financial runway you actually have. Comment with the account that is hardest for you to track, and subscribe for the complete WealthMap operating series.